Hi everyone, back again with another video about Alibaba. I've previously made a couple of videos on Alibaba discussing why I thought it was so undervalued. Since then it's dropped a further 10% on basically no direct news. Of course there's been a wider decline in growth stocks, but these are high price to sale multiples, no earnings, real high growth companies. Of course Alibaba is growing nicely, revenue's going about 29-30% a year, but Alibaba is not one of these companies, not one of these high price sales companies. It has a price sales of about 2-3, and it has a PE of about 15. It's a highly profitable company. It doesn't have a lot of debt. It's exactly the type of company that you'd think could provide a little bit of a margin of safety in a high interest rate environment. The obvious news, the reason why Alibaba is dropping a bit is because of increasing delisting fears after Didi has announced it's going to delist. And this seems to have caused a significant drop. I think these worries are massively overblown. I'm going to be talking about that later on in the video and going over why Alibaba is so cheap in my opinion. Just like to remind you, if you're enjoying the videos, can you please subscribe and like the video? Thanks. So this is just an article from Bloomberg saying that Didi has begun preparations to withdraw from the US stock exchanges. So basically the Chinese government has more or less told them that they have to delist. This is because Didi listed against the Chinese government's wishes. They had cybersecurity fears because of potential access to movements of Chinese nationals, particularly government officials. You know, Didi's a ride-hailing app, and they weren't sure about the cybersecurity, how secure Didi was, and if its data could be accessed. You know, where Chinese nationals are going to and from. So these are, rightfully or wrongfully, these concerns were ignored by Didi seemingly, and that has led to Didi being asked to, or being told to delist from US stock exchanges. So on screen, there's 7 Chinese companies' ticker symbols and their year-to-date returns in percentage terms, all down double figures, most of them down more than 40%. That's Didi, Alibaba, Pinduoduo, JD.com, Tencent, Baidu, and Neo. The reality is, in my opinion, is Didi is being delisted because it ignored government warnings on listing abroad due to some security concerns, and the Chinese government is snapping back. These are all down, in my opinion, because of just fear around wider scrutiny on Chinese stocks, and that the government can have an outsized impact on them, and they're clamping down a bit on regulations. Personally, I think these fears are not completely unreasonable, but definitely certainly overblown. These companies are all industry heavyweights, and they're companies that are very important to the Chinese economy, and the companies that aren't going to go away. I think they're all absolutely excellent companies growing at tremendous rates. I think the delisting concerns and the regulation concerns are well priced in, particularly on Alibaba, down 46% year to date, but down even more. It's now roughly a third of what it was 2 years ago. This is crazy to me. Looking at some financial metrics, Alibaba's financial strength is excellent. It has a really strong cash to debt position. Again, the type of thing you want in a potentially high interest or increasing interest rate environment. Debt to EBITDA is excellent. They have great interest coverage, and they have a safe Altman score. This is a company with a strong balance sheet. Profitability wise, they are absolutely excellent. Versus history, not so good, but again, this is 2021 is a strange year and is certainly causing a clamp down on margins. But operating margins and net margins, particularly for the e-commerce industry, are absolutely outstanding. Really, really good. Return on equity, really good. This is a strong company. Super profitability numbers, can't say enough about that. And just a completely investable balance. Valuation-wise, Alibaba is exceptionally cheap by basically every ratio and number you can think of versus historical valuations. This is as cheap as Alibaba has ever been on a fundamental basis since being on the US market. The stock has not been at these stock prices since 2017, and the company has been growing at 30% a year since then. So that causes massive multiple contraction. So its PE right now on a trailing basis is 17, on a forward basis is just under 14. These are absolutely incredibly low valuation versus any time in Alibaba's history. A bit more of a quantitative look, looking at a DCF, so using earnings per share statistics of around 20% growth per year, which has been doing for the last 5 years, give or take, and a discount rate of 8% for the wider stock market returns, and a terminal stage of around 4%. This gives Alibaba a fair value of $328 compared to its roughly $120 at time of recording. Absolutely ridiculous. Exceptional margin of safety. I think all the concerns are absolutely priced in and then some. Definitely opportunity here at the very least. After my initial evaluation, I was really attracted to the company, and I've been adding to my position over the last few weeks. Over the next 5 years, I think Alibaba will remain a US listed company, and this will be seen as an incredible opportunity. So as we speak, Right now, the company offers over 150% upside based on intrinsic valuation, which I think is just absolutely nuts, and you'll struggle to find a cheaper, more quality stock, in my opinion. At least among mega cap companies of, say, $100 billion or more. Right now, it's a $330 billion company, just under, and is roughly a third of what it was in October 2020, which to me is absolutely nuts. Ultimately, I think China is definitely not trying to kill these companies. It's just trying to wrestle some control, protect its workers' rights, prevent monopolies, and protect its data. These are things that other governments already do to a large extent. It's just China is doing it quickly and stamping down, basically, stamping the feet and putting some regulatory pressure on these companies. The SEC has spoke about a 3-year plan to delisting, but it has hesitant to do this, and the delays suggest that it's hesitant to delist them because any delisting hurts the US industry's chances of getting foreign companies on, and foreign companies are important to the US industries, and they're important to foreign companies to get access to the US markets, to get the premium valuations that the US markets provide. So I think all in all, it's a lose-lose for Alibaba to delist from both sides. I think there will be a cooling of tension in the next few years, and Alibaba and others will remain US companies. I think the chances of delisting are relatively low. With that being said, I think right now we've got a chance to pick up Alibaba with 150% upside to its intrinsic valuation and an incredible margin of safety. That's why I've been adding so much to it recently. But again, this is just my opinion and should not be taken as investment advice. Thanks, I'll see you again.